Hello everyone and welcome to Financial Accounting with Anne-Marie Anderson. Today we will be learning about adjusting entries, specifically deferred expenses. First, why do we prepare adjusting entries? It's because we use the accrual basis of accounting in order to follow GAAP, generally accepted accounting principles. The accrual basis recognizes revenues when they're earned and expenses when incurred, regardless of when cash changes hands. This provides a more accurate picture of financial performance by matching revenues to the costs that generated them in the same period. There are four primary types of adjusting entries, and their treatment is really all about timing. If cash is received or paid before the period end of the year or end of the month, but the revenue hasn't been earned or expense hasn't been incurred yet, this is called a deferral. Alternatively, if the cash comes after the revenue has been earned or expense has been incurred, then we must accrue the revenue or expense at the end of the period. See, it's all about the timing. In this video, we are going to cover deferred expenses, which can also be called prepaid expense or a prepaid asset. A deferred expense is a cost that is paid in advance but provides benefits in future accounting periods. It is recorded as an asset initially and then gradually recognized as an expense as the benefit is used or consumed. Let's start with some common examples of deferred expenses. Welcome to Claudia's Gardens, an eco-friendly year-round lawn service. Claudia needs a little help with her business. She has just taken out a 12-month insurance policy costing $1,200 on October 1st and isn't sure how to record it. The initial entry is a debit to prepaid insurance and asset account and a credit to cash for $1,200.
October, November, December.
Well, 3 months have passed and Claudia has used 3 months of insurance coverage at $100 per month, or $300 for 3 months. If we took a look at our prepaid insurance account in the general ledger, it shows $1,200, but we know that's no longer correct, so an adjusting entry needs to be prepared. We need to reduce prepaid insurance with a credit of $300, and the offset is a debit to insurance expense for the insurance that was used over these past 3 months. That leaves prepaid insurance at $900 for the following year. Remember that our T accounts are just a tool to help us prepare the journal entry in the general journal, so the actual ledger would then need to be updated to reflect the adjustment. Now the prepaid insurance ledger correctly shows $900. Let's look at one other deferred expense, supplies. We purchase supplies in advance, but until we use them, we don't record the expense, we defer the expense. So Claudia bought $800 in supplies on October 1st. These could be things like pens, paper clips, paper, and so on. Journal entry is a debit to supplies and a credit to cash. Over the course of the month, the supplies get used to write checks, print invoices, and so on. At year end, Claudia takes a quick inventory of her remaining supplies and she only has $220 of supplies left, which means that she needs an adjusting entry to record what was used over the last 3 months. Right now, supplies has an $800 balance, but we know it needs to be $220 since that's what she actually has on hand. That means a $580 credit to supplies and a debit to supplies expense to show the cost of supplies incurred over the last 3 months. Once again, after the journal entry is prepared, the ledger for supplies needs to be updated to show the correct balance of $220 at year end. The simplest way to think about deferred expense is it's something a company pays for early and then uses up later. It starts as an asset and becomes an expense over time. Some key takeaways. Deferred or prepaid expenses are assets initially. They become expenses as the benefit is consumed. Adjusting entries ensure accurate financial reporting. And it's really the matching principle in action. Remind me, what is the matching principle again? Well, the matching principle is the accounting rule that requires expenses to be recorded in the same period as the revenues they help generate. So with these adjusting entries, we are making sure that the expenses are being recorded in the period they were incurred. That wraps up deferred expenses. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.